Okay, well, we speak about markets, especially after that 2.5% fall that the Sensex and the Nifty saw yesterday. Two big cues, the RBI warning that inflation could be a little higher than it expected and growth could be a little lower than it expected, and that getting followed up by the Met Department lowering its monsoon forecast. Now a 12% deficiency in the rains, clearly deficient monsoons as they call it. How do all these add up to earnings and to markets? Arvind Sanger of Geosphere Capital Management is joining us. Good morning, Arvind. We couldn't have asked for a more crucial day to have you with us. Put this into perspective. Should we be extremely worried about the deficient monsoon, considering that agriculture in general and food in particular is forming a smaller and smaller part of Indian GDP?
Well, by itself, it would be a small issue, but we've just come through an extremely disappointing quarter. I'm not sure who is coming up with the GDP numbers that India is now printing, but they put the Chinese GDP made-up statistics to shame, because at the end of the day, the fact that you had virtually no top-line growth in private sector India, or very little in this quarter, suggests that GDP is actually quite sluggish. So I think, against a backdrop of a very weak growth and the backdrop of very disappointing earnings numbers, the earnings were down for corporate India, at least the public companies that have reported so far. If you have other negatives, one of which is obviously the monsoon concern, and the second is now less hope of RBI providing any more tailwind beyond this 25 basis rate cut. So when you combine all those together, I guess we're running out of things to get optimistic about right now.
Okay, but are you getting disappointed enough to sell out your portfolio that you have at the moment?
No, we are not disappointed enough to sell out, but we've gotten, I guess, maybe less long in the last few weeks, given what we saw was a tough earnings season. But I think, pullbacks, we have to be a little more selective than I thought we would have to be at this stage, because, the macro growth story looks like it is going to be way, way, way slower than any of us would have expected. Private sector is clearly not in a capex or spending mode. Some of the, consumer sectors are starting to see signs of life. So we have to be much more selective of where the signs of life are, and wait and see how things unfold in terms of, some of the factors that could help drive a broader recovery in the Indian economy and in the Indian, stocks earnings. And that would require, obviously, more, action both at the government level as well as corporate confidence to drive some of the, virtuous cycle of meaningful growth. And again, I really pay very, very, very little attention now to Indian GDP numbers, given those revised numbers make no sense.
Okay, fair point. Arvind, hi, good morning. What could the downside of this market be now? Are we staring at just a time-wise correction that we could be seeing in the next 3 to 6 months? Or is it a price-wise correction where this market could head well below the 8,000 level in the near future, you think?
Well, so there are two macro factors we've not talked about. One macro factor that could drive very short-term risk is what's going on in Greece, and that could drive some short-term volatility. I think at the end of the day, the Greek exit, if it happens over the next few weeks, will prove to be, largely a non-event, but it will cause some near-term volatility, and that could drive, Indian markets weaker. And the second factor, which I think, RBI talked about, is what happens to oil prices. And there are a few things going on that could drive that. There is the Iran negotiation, which is supposed to conclude at the end of this month. And there are other supply-demand factors. Our view on oil is trending higher. By the end of the year, it could reach $75. But that's not a huge move from here when it's already at 65. I would say that in the near term, oil, you could see the Indian markets range bound, Nifty, in the low 8,000 to 8,500 range bound. And I don't see a massive, correction beyond that, barring any big surprise on the global macro front. Other than that, I think maybe it is a time correction, and maybe we have to wait for, frankly, at the end of the day, we have to wait for broader earnings recovery, visibility for the market to move higher. So I think it is very much now a show-me market. No more are investors, including us, just buying on blind faith that all of the right things that are happening in India will drive a recovery, because unfortunately it has not showed up the way that most of us anticipated a year ago how recovery would shape up by this time in India.